this is the thing that I think is important, and people need to realize that this has happened in U.S. history, is during the Great Depression, FDR, he took an emergency action and he required Americans to turn in their gold.
Jeez.
Now, under there was a penalty of prison.
Yeah. Yeah.
Right.
This was the government, the people's choice, just overtly stealing from them, frankly.
Yeah, gosh, that doesn't happen today, does it? So, and then they would revalue the gold at $35 per ounce.
Yeah.
Right.
That's right.
But before, if you were a citizen, you could take your gold down. I mean, you could take your money and redeem it for gold.
That's right.
From that point on,
yeah,
you couldn't, and only foreign governments and central banks could do that.
And there's always a great cover story, right? Like, hey, we need this to fight this war. We need this, right, to save you. There's always that. Yeah, I won't go down that rabbit hole, but that's how this was sold to the people.
Right. And then Nixon finally put the last put it to bed, so to speak, and in 1971 took us off the gold standard. And that point, even governments couldn't redeem dollars for gold.
Yeah. Well, the thing that I don't want to miss is, we had the Bretton Woods Act, and that when people talk about the US dollar being the world's reserve currency, it's from Bretton Woods. And, we might be, we might have a stinky currency, but we're the least stinkiest in the world because we are the world's reserve currency. Oil, by OPEC rule, can only be bought and sold in US dollar. So that's what's helping, any stability that we have right now, at least in my mind, is rooted in that. And then Nixon, what he did, here's the funny thing is it was all billed as temporary. It was sold to the American public that we'd go off this, we close the gold window, but only temporarily. And this is where, if you listen to Robert Kiyosaki, he just goes through the roof talking about this event in 1971 and when he was in Vietnam, and he started realizing, wait a second, there's going to be a fundamental change in the way the world economy works because of this quote unquote temporary event.
Absolutely. And so now we have fiat money, which is backed by what?
Emotion.
Nothing, right? And so what happened when we got off the gold standard?
Well, now we had this little issue called inflation.
Yeah, exactly. And if you know what's happening, you'll know what to do, right? So that's what when we think of what happened in 2020 and how much we increased the money supply and how much we're going to increase the money supply in 2021 and all of these things that are happening, I'm just telling you, we have to do something, right? But we're not going to go down that rabbit hole. All right. So there's something else that happened 3 years later.
Yes.
What was that?
Yeah. So 1974, ERISA was enacted, and that birthed the IRA, and a few years later birthed the 401k. So I think about it's the birthing of giving up control of your money to other people.
Absolutely. And what it did is it saved Wall Street. So if you look at what the government is doing, right? The government's protecting itself, protecting the banks, protecting Wall Street. Where is it protecting the citizen? Where is it protecting the taxpayer? The taxpayer really is the host, right? Yeah. The parasite of the government lives off the host, but it's never protecting, it's consuming the host.
Yeah, that's right. Like it's really theft, but it's always done. So remember how we sell with emotion, and then we have to follow with logic. And it's always, hey, we're here to help you. We're serving you. You got to do this to help your brethren. But if we dig in and apply any logic to it, there's really no logic to it.
Right. So if you look at there's a table 3, increase in market values of individuals' financial assets total and by components 1950 to 1985, right?
Yeah.
But let's just look at one area for a minute, is life insurance reserves, right? This is where people held money, and in 1950, 19% of somebody's net worth or whatever was held in life insurance.
Yeah. So it was a percentage of the total increase in financial assets in 1950 was due, 19% was due to life insurance reserves.
Right. And in 1985, 2%. So what was that basically saying?
People were moving money out of that and transitioning and putting money where? Well, we just gave you the clue. It's moving to Wall Street. And if you look at the run up of Wall Street, it was because we were people were basically being incentivized to put money there. It wasn't because people thought, hey, that's such a better value. It was just sold that. And naturally, if people through IRAs and 401ks and the employer, the corporate benefit to having a 401k for your employees, well, of course, if you put more money into it, it's going to go up. But it wasn't necessarily because people saw value in it. It was just incentivized to the employers.
And they got a tax break, a pretty substantial tax break to do it, right? So think again, who's controlling that play?
That's right.
And
it's a government program. As we said on a previous episode, all government programs have wound up doing the complete opposite of what they were intended to do.
And then he talks a little bit about briefly about the FTC report where, and that's the Federal Trade Commission in 1979 that kind of said, hey, whole life insurance isn't a good place to put your money.
Yeah. Well, right? Ralph Nader didn't care for the fact that you can't see all this breakout. It's a bundled thing, right? We've talked about that before. It's bundled. And so what came of this?
Is universal life.
How well has universal life worked out?
Well, in the last 40 years, it's failed twice. And I would say it's failing again because it's not doing what it's projected to do.
Yeah, it's just a fancy illustration. It looks good. It's for somebody else, though. It's not for the consumer at the end of the day.
Right. Exactly. It puts all the risk on the consumer. And some of these insurance companies said, hey, you know what? Look at ERISA. Some of these citizens, they'll take all the risk. They're taking all the risk on the do-it-yourself defined contribution retirement. So why won't they do that with their life insurance? Oh, they will. All we got to do is give them an incentive and make it look really pretty. Right? Yeah. Okay.
Jim, if we were starting a life insurance company, would we, if we wanted to be profitable, would we sell, as the owners, would we sell universal life or whole life?
We would sell universal life because nobody keeps it. We never have to pay a benefit.
That's right.
Or we would sell term insurance where less than 1% ever pays a benefit because there's only one benefit.
That's right.
Universal life is term insurance. Invest the difference. Invest the difference in what? High interest rates. Oh, we don't have high interest rates. So that failed in the 80s. The stock market. Well, there was a couple of corrections in the stock market that blew up all those policies and their projections. Then it was a guaranteed UL. We'll guarantee you have death benefit. Then the insurance companies didn't like the way that looked long term. And then now we have indexed universal life, right? So we try to make it a little bit more complicated with ceilings and floors and some other stuff to make it just so you don't quite understand it. So you think, well, that's what the guy's telling me to put it in my quote CPA or CFP. And so that's what I'll put it in.